everybody. I hope everyone's had a good week. We're going to wrap it here this week. Boris Schlossberg, CNBC contributor, will be with us. I just want to acknowledge one of the pioneers to ForexAnalytix, my friend Ziggy. He's a great follow at ZiggyFX. And this is what he said today. The market's like a puzzle. Each day you must try to put the pieces together. It's like a jigsaw puzzle. So this is what I think is happening on the jigsaw puzzle. Good morning, Brock. So let's start off with really, I think the key to everything is yields, right? How much it costs, opportunity costs. So yesterday we had a little pullback in TLT. I think it's just a hope pullback here. I don't think TLT is going to get through 38 and we're on the verge of a breakout. So this is a piece of the puzzle where I'm looking for lower yields. And here's a 10-year. Still hasn't broken down. Looking for a breakdown. That is the 10-year. And here's the 30. 30 even weaker, got to the trend line and bounced. I still think this is a breakdown. So what's part of this scenario? I think is a flight to quality. Bank shares have had a lousy week because something we talked about this week is that the steepening of the curve has shifted back towards moving back towards inversion. So that's part of the puzzle. So if this is going to happen, let's look at the other pieces of the puzzle. So, and this is something Greg had talked about yesterday, looking for one more decline in yield. So, you know, that part of how I put the puzzle together is with these guys, okay? So you don't have to do a puzzle yourself, right? I mean, didn't you ever get together with your family and just throw all the pieces on the kitchen table and everyone tries to look at the different pieces, make sense of it, and try and find a piece that fits? Well, you know, I have a whole team, and all of our subscribers have a whole team when we throw the jigsaw puzzle out there to solve it. So that's a big edge for me. It could be a big edge for you too, especially since we're giving you an even additional edge by it costing you less to join our family. And don't tell me it doesn't cost you anything to be part of the family, your blood family. It may not always be money, but it costs you. But what does it do for you? It enriches your life. So this part of the puzzle leads to this. I'm going to wrap it up in case Blake wants to get going, but something that I asked Greg about here. Could we have one more extreme move up to new highs in the gold for a 3 up here? And I would think that if the bonds are going to rally, that we're going to have a pretty good rally in gold. I still think there's a chance because of this momentum here, and even the divergence was almost 80. That's a lot of mo. And on a weekly basis, we held, okay, under this week's lows. There's problems, but not, you know, we are closing back to higher on the week after they tried to sell it off. So that's the second part of the puzzle. One more low in yields, one more high in gold. If that's the case, US dollar yen is in a topping zone. Okay, it had a decent week, but I don't know if I bought this breakout here at 70. Yeah, I'm up, you know, 40 pips, but it's not that impressive. So we could get a breakdown here. And then the last piece of the puzzle would be risk off. So we'll see. That's the way I'm looking at the markets now. Euro, you know, I just lost patience with being long in here. and I look at the week on Euro, and it doesn't look that great to me. You know, I've been giving it a chance. I've been buying dips for, you know, a couple of months now, and you know, there's been, you know, 60 pip trades, 50 pip trades, but I look at this close, if we're going to close down here and we're actually going to have a weekly sell based on the 2-week off number, it needed to close over 111.59, so we're 40, 50 pips away. So it doesn't look good to me. And you look at the Dixie, and it's had a good week. It's actually a 2-week buy signal. And maybe we're going to get one more big rally in the dollar. Maybe FX coal. FX coal is the one who 109 you're looking for. Okay. Okay. Yeah. Well, I think we get one more rally there, and that's really the puzzle. The other part, maybe one more piece of the puzzle, of the jigsaw puzzle that I see is what happened in crude is real. It looks pretty negative to me. Greg also showed this, but you know, this was the first tell up here. So we'll see. I just can't get short down here. I actually did it this day, although I was $1.50 early, you know, it worked out. So that's a puzzle. Lower yields, peak in US dollar yen, another blow off in gold. What I'd really like to see, and it doesn't look like it's going to be this way, and that's okay, is with silver, have a failing rally in silver. Okay, I want to see what happens if highs are tested by either of these, gold or silver, and the one that's not making the new high would be your preferred short. So that's how I see things going home over the weekend. Thank you, Ziggy, for always supporting the Faith's webinar with your tweets. And guys, I hope everyone had a good week. I know that we laid it all out here on the floor for you guys. I know by Friday I feel spent, but I feel good that I've been out there trying to serve the trading community. You could see that Blake is doing it as well, twice a day, free webinars for you. So we walk the talk here. I know it's a business, but our motivation is to build up and edify everyone that reads our research and everyone who hangs out with us during our webinars, and especially all those who are in our members chat. So have a great weekend. Weekends are a good time to join because you can take your time without the heat of the markets. Yeah, I would say that. Yeah, everyone's saying, you know, I talked to Brock, I talked to Blake about it, that everyone thought it's just a layup, that President Trump with McConnell have it all sewed up, but certainly seems to be a lot of momentum, and probably not a coincidence that all these new evidence or witnesses are starting to come to play. So yeah, you know, so if you really want to think about a big picture, Brock, I'm not saying this is a lock, but I mean, let's look at the weekly. All right. So Trump was elected. I have to look at the monthly. So if you really think he's going to be removed from office, this is a Trump rally. Okay. It began from here, the end of the year, right? 2016. This whole advance, if you believe that it's a Trump rally, you know, if there something happens, and I look at him, he doesn't look that healthy. I mean, there's, you know, I don't want to, you know, jinx him, but you know, we have lost people in office, president. There are cycles, but if Trump goes away, why can't we negate the whole Trump rally? And I know this is a lot of the bears' targets, 2,200. So Brock, that's a good point. And with that being said, we're almost at Blake's number that he's been talking about for quite some time, some confluence in S&Ps. What are we, Blake, about 10 handles away from that number?
From where?
In the S&P, that confluence of
Oh,
the,
no, we're above it. Yeah, we're about 10 points above it.
oh, okay, I thought it was 33. What's 13?
It is hold on one second. It was
Give you a shot.
15.
15? Okay.
15, yeah. So you can see we're slightly above that confluence. I want to talk about a couple of things, Dale, before while you're here. Let me first and foremost mention Ziggy. You had mentioned Ziggy. He had been a longtime listener of my um, Morning Edge webinar. I'm talking like for years. I want to say 7, maybe 10 years. Anyway, about 5 years ago, he was moving from Las Vegas, where he lived, to New York to spend, you know, the you know the rest of his life. He wanted to be around his family and his grandkids, and so he moved. He was moving back to New York, and he drove through Phoenix from Las Vegas, maybe about 4 years ago. I would say, Ziggy, if you can recollect, it was probably about 4 years ago. Anyway, I had the great pleasure of meeting with Ziggy, having lunch with him, chit-chatting, meeting him in person. And it was such a pleasure because I'd been interacting with him for, like I said, 7, 8 years in our chat rooms, on our webinars. And he continues to be a really big supporter of what we do here and what I do just in general. And he's really, just one of the nicest people you're ever going to meet. And he
Met him.
doesn't spend as much time in the chat room anymore because he's with his granddaughter a lot. But when he pops in, and he always listens in to the webinar, but when he pops into the chat room, we always love having him there. So Ziggy's great. He is wonderful. So now I want you, Dale, you talked about puzzle pieces, right? Because that's what Ziggy mentioned.
Yeah.
So let's talk a little bit about that. So here we are with the S&P. We are above this confluence. A couple things I want you guys to note here. Here is the DSI reading from last night. VIX DSI reading is at 9. That's an extreme low level. We've been at 9, 1, 2, 3 times this week, and multiple times over the last couple of weeks, we've been below 10. I did tweet about it because somebody put some statistics up about it. But that's an extreme low complacency level. S&P's at 92, NASDAQ's at 93. Those are extreme bullish readings. Those are complacently bullish readings. Very, very extreme. Whenever we reach below...
Add palladium to the mix.
Yes, when we reach below 10 or above 90, it is complacency at its best. All right, now, again, we're talking about puzzle pieces. One of the other things that you might have noticed today is gold. Gold is rallying. We are continuing our uptrend. We are struggling to really close below 1550, and we're holding up. Silver is holding up. The dollar yen is not breaking out. The dollar yen is stalled at the 100. I'm so irritated because I pulled my order at 110.25 last night because I didn't want to get stuck if the dollar yen went like this last night. I just didn't want to. I didn't want to take the risk and wake up with a 50 pips stop loss and get stopped out and things 80 pips higher. So I just pulled my order, which obviously I'm a little irritated about because I would be up 15 pips right now or 14 pips. But anyway, that's neither here nor there. What I'm trying to point out here is that it is struggling to break out as S&Ps are at these all-time highs. So you got that happening. You've got bonds. Take a look at bonds here. Not the yields. Let me take you over to the 10-year. So here's your 10-year. Now, if things were so great, bonds would be going down. We'd be below the 200-day moving average in the 10-year, and yields would be going up. yields on the short end on the 5-year, 2-year are going down. Yields are up a little bit on the 10-year, just slightly, but that shift in the curve is also suggesting some near term, like, oh, I need some protection near term. So the point I'm trying to make here is bonds aren't going down. They should be, but they're not. Gold's not going down. It should be, but it's not. The dollar yen should be going up, but it's not. The S&P is still going higher. So when you put all these puzzle pieces together, you've got to be really, really questioning. And then you saw DSI readings where they're at. You've got to be very careful with being bullish the S&P at these levels. One last puzzle piece I want to bring to your attention is something that I posted on Twitter, but I mentioned to the chat room, I'm going to mention to you guys, the dollar Mexican peso. The dollar Mexican peso is testing levels we have not seen since October of 2018. Do you guys see that? Dale, do you see this low?
I think
he's in the toilet. Yeah.
Okay, so Steve, you see that low, right?
Yep.
What happened from there?
Yeah, we had that massive rally.
Amazing rally. But more importantly, do you know what happened to the S&P at that point in time?
Back then, yeah, of course.
That was a drop, wasn't it?
Yeah, it was the big corrective move lower.
Yeah, we sold off 20%. So I'm gathering all the puzzle pieces for you guys. Dollar yen's not rallying. Gold's rallying. Yields are coming down. Bonds are rallying. Stocks are, I don't know why they're up here. Dollar Mexican peso is pivoting off some really key support. Guys, I'm not saying that we're going to have a 20% decline right now, but what I am saying is that the risk now of the S&P pulling back is quite high. And we have a lot of puzzle pieces that are falling into place. Does that mean the stock market's going to go down today? No. I mean, we could end up going, doing a turnaround Tuesday. We could go up today and stay where we're at today, go up again on Monday, and then Tuesday, reverse. Or something like that, or maybe something happens over the weekend where stocks close up here, and then we're down 2%. Right out of the gate. Who knows? But I'm gonna say that extreme complacency is here. Now there's a couple other things that I wanted to mention before I turn over to Andre, because Andre, you guys are really lucky because he is our harmonic in-house harmonic expert. So all the beautiful charts that you see here, okay, they come from Andre. So he's going to talk about what he's seeing, and so you guys get this special treat today. So I don't want to take too much away from him. But one last thing I want to mention is in regards to everything that's happening. You got a bunch of big options that are expiring today. A lot of dollar yen options, a lot of euro dollar options, huge options at 111, huge options around the 110 level in the dollar yen. We're trapped in these areas because you have so many options that are expiring, so much gamma around these levels. They expire today. So it's going to open up the ability for these currency pairs to move a little bit going into next week, which is really important when you look at all the inflection points that we're seeing, whether you're talking about stocks, gold, yen, yields. Does that mean the dollar yen can go to 109 or 112? Yeah, I can think it could go to either side. The euro could drop to 110 or it could go to 112. Yeah, we're at 111 today. What I will state, and I had this question in our chat room just a little while ago, JD asked, hey, Blake, if the S&P does come down, what do you think the euro will do? And my assumption is it will go higher. This has been my assumption all along, and it continues to be my assumption. And here's my case. The euro dollar is one of the biggest funding currencies in the FX market right now, as far as the majors go. If you doubt anything about that, go ahead and go long the euro dollar or if you've been along the euro dollar for any extended period of time, let's just say, 2 weeks or a month, if you've been long the euro anytime over the last year or 2 years, what you'll notice if you go take a real deep dive in your P&L is your carry cost for carrying the euro dollar is quite high. So you get paid, or institutions really get paid, when they hold short euro dollar positions because of the interest rate differentials between from the Federal Reserve and the euro, or the ECB. So when you have the ECB at zero and you have, the Fed, funds rate higher, you're going to get paid interest by holding short euros. That's great in a risk on environment. When that reverses, that dynamic reverses. If you guys don't remember what happened in the mid 2000s, the same thing happened with the yen pairs. Everything was honky dory, and then all of a sudden you saw some risk off and all the yen pairs took an absolute nosedive. You're going to probably see the same situation with the euro. You'll see the euro spike up. And if you don't believe me, you have to look at the euro and see how it even responded during this Iranian situation, which was very, I don't know what just triggered. Hold on real quick. Oh, it's a euro dollar. Just we're touching the support here. When all that Iranian stuff was happening, you were seeing spikes higher in the euro dollar. These spikes higher were due to people going, "Oh crap, I'm short the euro. I need to get out." And they were very mild, but you know what? The stock market retracement was very mild too. I mean, we saw maybe 1.5% pullback, and then the markets just resumed higher because, as I told you at that point in time, there's no reason to really be short stocks. I mean, it's just it wasn't a big deal. People were making a much bigger deal than it should have been, than they should have been, and so the euro obviously is come off again because we're at highs. But listen, if the stock market does start to see some selling pressure come in the coming days, I would expect that the euro trades back towards 112 and maybe even higher than that. So you guys have to be really careful. And by the way, I have no euro dollar exposure right now. I have been buying dips, but I've chose to trade a little differently today. If you're part of the ForexAnalytix community, you're in the chat rooms, you know what I'm doing. But I'm not long the euro at this moment, but I sure as hell wouldn't want to be short. Let me just put it that way. All right. So with that being said, I'm going to pass it over to Andre, because I know Andre is here, and Steve, obviously, and Stelios and Coach and everybody else. But I want to hear Andre's Portuguese American slang. How about that? Is anybody here? You guys hear me?
Yes,
Hey.
yes.
I'm here. I
Good
think
morning.
Andre is
Just-
as well.
We're just
Where is
not
Andre?
We're just
Here.
not
Wait,
laughing
we
at
got
the jokes.
Oh, you're. But you know what, Andre? Are you here? Can we hear you?
I heard him laughing.
He seems to be unmuted.
He seems to be unmuted, but we can't see. He doesn't have any video capabilities. But anyway, how are you guys doing? While he's figuring this out, how are you guys doing today?
Very good,
Good,
very
Blake.
good.
How have you been?
Good. TGIF. I'm happy that it's Friday. So
TGIF indeed.
Yes.
Anyway,
okay, while we
what?
get Andre, I have one thing to talk about, if you're done and if that's okay.
Yeah. Tell us about this UK sales and then Brexit.
Yes. So we had UK retail sales, negative numbers, negative revisions, really not good numbers at all. Continuing in the same fashion of the past few weeks and months. The question though now is we're getting very close to 31st of January, which is the official Brexit date. And we also have the Bank of England meeting that day. And what's been happening in the markets is that we are now pricing a good chance of a cut at the end of this month. So we're 60-70% chance. And people are understandably turning to that now because we'd forgotten all about it for days and days, and now suddenly it's come back in the horizon. And question is, what do they do? If they cut, it's a sort of message they're sending. So they could cut preemptively to try to smooth things on the start of the transition. I mean, I don't think it's going to do any noticeable difference to the economy or anything, but it's all about sentiment. So they could do that, and the Bank of England have been dovish and led by a big dove, Mark Carney. So it's a question of what they're going to do. But the main thing is that now we're pricing 60-70% of a chance of a cut. So no matter what they do in January, there's going to be movement in the pound. That's for sure.
All right. Well, one of the I was just reading a research piece this morning that was just saying that we got the Bank of England might kind of mute the data a little bit, and so it'll be interesting to see if there is a bounce back. As a bounce back going into the beginning of the year, especially now that we've gotten past the main Brexit issues. So anyway, it will be interesting moving forward, and you can see the cable downside has been very limited. I had an order to buy the pound earlier, last night at 130, actually 130.35, I think is where my order was, and I pulled it because I just it's like I wanted to sleep and didn't want to have to deal with an open like getting an open position on a Friday. This is the worst thing to wake up and it's a Friday morning and be down a big amount for me. So it ruins my whole weekend. So I pulled that order, and looking at it right now, it's like, oh man, I should have just left that order in. But I don't live in that world, that woulda, shoulda, coulda world. I just didn't. But anyway, I'm going to pass it over to you guys. But you guys keep an eye open for the Michigan numbers today. Those are going to be fairly important as all these options roll off. And Steve Stelios, I think Andre's mic is fixed, so I'm going to pass it over to you guys.
Thank you. And by the way, our friend Richard says, I disagree. A 25% cut of in the UK will mean millions of mortgage holders will have more money to spend. Yes, but on the other hand, you have savers who are going to be getting less income, and it's not just loans; it's all sorts of stuff. So anyway, it's
I've talked about that.
You are right on that.
Stelio, hundreds of times. Savings are the steam engine of any economy, and we've kept penalizing prudent economics and savings more and more, just to postpone the inevitable problem for kick the can down the road a little bit further in the future. This is not going to end well. Yeah,
but I mean, I agree. Richard is right in what he's saying, but there's also the other side of the coin. That's what I'm saying. Okay, I think, we have numbers in a minute and a half, and also we have Andre joining. So maybe we go through the numbers, Steve, and then we...
sure. Blake, if you're still here, you can go ahead. I think, it's the best.
Anyway.
Okay, so let me share.
So we have building permits.
Yeah, we have
starts and then job openings later.
Yeah, building permits and Michigan, that's it actually.
Quite a few things actually. Industrial production, Michigan. Yeah, it's not.
You ever heard that Hendrix tune? Financial repression's a frustrating mess.
No, is that the real one?
No, manic depression. But I just changed it.
Okay.
Jimmy won't sue me. He's gone.
Yeah.
That's very true. no big chance of suing you.
It's my favorite guitarist of all time.
He's good. My favorite is Joe Satriani, but it's a different.
Oh,
different
yes.
He's good. He's good. Okay, so we're what?
What else did we have, Stelio, overnight? And I'm going to go through a couple of charts very fast so we can then, give all the rest of the time
to... We had some Chinese numbers which were in line with...
yeah, actually we had Chinese GDP, right? 6.1.
6% year on year, 1.5 quarter on quarter, exactly as expected, and do whatever you want with those numbers. But they came.
I know what to do with them actually, but I can say it on the webinar.
Some minor Swiss PPI numbers, nothing major really. I mean, Eurozone inflation came in at 1.3 as expected, and same as the previous print, 1.3 year on year. Nothing else happening. So let's see the numbers in about 10 seconds. Drum roll.
Yeah, Richard, I agree with the last part that you're saying, that it's not going to make much of a difference in what they get from banks. But, the general point is that economy, interest rates, and everything else is in completely wrong direction. That's the whole point.
We're getting
Okay, so we had
something.
better housing starts,
Yeah.
a little bit worse building permits. Yeah, I doubt that this will move the market one way or another.
No, we have two FOMC members speaking again today.
So one thing I wanted to show the who do we have speaking today, Stelio?
Harker and who was the other one? Quarles. I don't know how to pronounce that name.
Okay. I doubt that the market is going to care much. I mean, we're going to get some, dovish rhetoric most probably, but the market doesn't care about chit-chat anymore. And the Fed, oppositely from what they say, they are in a given path. I mean, neutral for now, but during a bearish part of the cycle. I mean, we've started a new dovish cycle once again. I mean, the Fed's balance sheet is growing at quite a unhealthy actually pace. We know that the next move is going to be lower whenever we see that. I mean, Powell was quite clear that the only way they would even consider moving higher would be if they saw a big sustainable increase in inflation. So and they don't even care to define what that is. So not happening anytime soon. So a couple of charts, tell you, I know you're going to like this. So Palladium at its 18th consecutive up day, probably that's some kind of a record, I'm assuming. It's putting on an even longer candle. Now it has also overthrown this parabolic ascending channel after breaking through the other one. Now, what's interesting here is to overlay Palladium with the Nasdaq, actually. I mean, from this point on, as you see, it's like, actually, is this, wait a second, is this the right ticker? Yeah, okay. Let's overlay Palladium to this, actually, to make sure that it was the correct one. So, yeah, there it is. So Palladium and the Nasdaq seem to be more or less trading as, one market. So that's quite interesting. This is the reason I'm showing this is because we were discussing yesterday the fact that somebody was asking about, gold and palladium and how they can move oppositely from each other. The answer is exactly as gold can move oppositely from risk on assets. So if you see some risk off, I would expect palladium to tank, and I would expect that there is a high chance that gold isn't going to do that. Keep also in mind that palladium's DSI is at 93, which is beyond extreme, and the daily RSI is now above 90. So do what you want with it, but it's moving nicely. I mean, the more parabolic it goes, the higher the chance, as we said, that this thing is going to just produce some kind of a very violent move lower once once there is no more buying to be done here, because there's going to be only one way for it to move. Then the DXY, keep in mind, a lot of chit chat about this as well, but bottom line, the DXY has not broken out. I mean, we're still not even at the 97.70, 97.80 area. We're getting close to that. So
yeah.
Until or unless that happens, one thing is for sure. I mean, the DXY remains very well bid here, but look at what all the metals are doing. I mean, it's very likely that gold has already broken out the upside. No comment about, of course, palladium. I mean, this is completely nuts. Platinum has broken out to the upside. Silver seems to be breaking out from this pennant. If that's the case, we're going to find out soon. Gold, same deal here. So, I wouldn't be surprised to see one more push to the upside. I mean, 1625 is a nice juicy target here in gold, which is going to be this 161.8% extension of the...
And the third drive.
Yeah, and
that I've been
since
talking
you're looking
about.
for a third drive, coach, yes, indeed, that's also going to be a third drive as well.
You know, Steve, where you're talking about some of these exotic precious metals, I think our attendees should know that even precious metals have industrial uses.
Oh,
So
absolutely,
the
especially
reason
palladium. Especially
silver,
palladium.
yeah,
Palladium
right.
mostly has an industrial
That's why
usage.
it's more vulnerable to an economic
Exactly. It's not a
downturn.
monetary. It's not a monetary metal.
Right.
It's an industrial metal. Yes,
That's right.
exactly.
Okay.
Yeah.
Yeah. Like
Keep in
copper.
mind that there is a lot of speculation. I mean, actually, that's not speculation. I mean, there is the concept that one of the reasons platinum has started catching a bid is because it can actually replace palladium in some of the usages. So with
Catalytic
palladium,
converters.
yes, with palladium having become that expensive, what happens always, coach, when we have any commodity, going nuts in
Yeah.
price,
Trying to replace a substitute.
exactly. There is always going to be a drive for substitutes. And what does that do to the price?
That's what palladium was for platinum.
Yes.
That's
In
what's
some
a
aspect.
part of in catalytic converters. They started using palladium, I think, instead of platinum because it was cheaper.
So now that things have become extreme, I expect that it's going to be very, very soon. I expect actually next week to see like a sharp move lower in palladium, because as I said, this move higher is really unsustainable. I've already started shorting a very small position, or just 1/3 of a position, because you can't go with a full size position in this kind of markets, because they can really go parabolic. I mean, we're 4.6% higher than we were yesterday, so you can't go with a full position, because you can find yourself in a very hard spot. But I feel comfortable here, starting to build slowly a position. And if I see like a reversal, then I'm going to add on, because this is not the kind of position you want to build by adding too much on the way up, because it's already a huge outlier, the fact that we've had 18 consecutive up days, and some of them are like huge candles. So it's better in these cases to just build a small position and then add when you have confirmation that it's reversing than the opposite. Reason for palladium rise is China cleaning up its head. That's as well. Rhodium as well. That is a good point, Richard. XPD market is not liquid. That's true. It's not that liquid, but that doesn't mean that it's not. And perhaps that's one of the reasons we've seen the move go so parabolic. But this is a double-edged sword, Martin, because a market that isn't liquid can produce violent moves to the upside, but it can also produce violent moves to the downside, right? So illiquidity doesn't work only for bullish markets; it also works, for the opposite direction as well. So, it might be exacerbating the move to the upside, but it will do the exact same thing once there is no buyer left in this market in the short term, and everybody's like, okay, now we need to stand aside, and then it's going to collapse. The USD-CNH going up would be risk off. Yeah, but USD-CNH isn't going actually up. I mean, USD-CNH has been moving lower within this channel. And I'm actually, since you mentioned it, it's a good opportunity to show this, because we are approaching support. It remains to be seen if this channel is actually going to play out, or we might see a sharper move lower, because if we go through this channel, then we might be seeing a good indication that the move that has started lower is not corrective, but it's a change of trend, right? Usually these type of channels do a good job in defining that, if you have a corrective or an impulsive move. Anyhow, those were a few fast comments. Andre, is your microphone okay now? Are you ready for it? I can hear some static, but nothing more than that, Andre. Let me go through the questions. I'll let you know if I can hear your voice. Does your data also show that the Fed balance sheet has begun to contract? I haven't checked this week. I check once per week. I check every weekend the Fed's balance sheet. But I can tell you that until last week, That was not the case. The Fed's balance sheet was actually still inflating. So I'll let you know on Monday. I'm going to check during the weekend if that changed during this week. But I seriously doubt it. I mean, doubting it doesn't matter. I'm going to check the date and let you know on Monday. But really, I don't think that's very likely. I'm from the UK. The sentiment on trade deal I noticed globally is underrated. The cuts will have muted effect. I agree with that. I mean, one cut is not going to do much of a difference to the pound. I totally agree. For me, it's a buy on dips. Pound is undervalued. Yeah, pound is not that undervalued anymore as it used to be. But I agree with you. I mean, the only thing I see here on this chart is a horizontal consolidation within this triangle. And I still
Sorry,
think...
Steve?
Hey, now we can hear you.
Okay, thank you.
Good.
Okay.
Good, perfect. So to finish this, so I'm with you. I mean, I think it's a likely scenario that the next move is also going to be higher. So I also think that buying dips until proven otherwise is still the way to go. So Andre, what do you have for us?
Let me try to show you.
Absolutely, I'll stop
Can
sharing
I?
so you
Okay,
can
let
grab
me
the
try
screen.
to do.
Just go ahead and
Do you
go
can you
over
see
any
my
market.
screen?
Not yet. I'm going to tell you when I do.
Okay, no, I forgot to select the.
Yeah, you also need to select. Yeah,
screen.
now something
Okay.
is coming through.
Okay.
Yeah, there
Nothing
you
special.
go.
I was just checking this.
Cisco, I see.
Cisco, yeah,
Yeah.
just checking Cisco, breaking these eventual next zone there. It's an interesting behavior. Well, a lot of things I can show you. Obviously, Steve, as always, we have.
Just go to whatever market you want
Okay.
based on conviction. So go
Of
through the
course.
markets that you have the highest conviction on.
Yeah. So let's start with the DAX and with the daily time frame chart. I was projecting this pattern as soon as the market starts to trade above this monthly fractal resistance printed at 1264. So once the price breaks above, I started to project those patterns above, specifically at 1350. So this was actually reinforced with a new fractal there, but this is the extended crab pattern. So if you go into a lower time frame, and just to show you the previous, how constructive DAX has been trading recently, actually for quite a long already, with a few patterns suggesting the next price behavior, and we can also take advantage from those events. As you can see, we have a major or a higher degree. This is a parallel structure.
Nice confluence of resistances up
yeah,
there.
nice
Previous
confluence of
high, I see
resistance.
some extensions there.
But it's interesting to see those events, those heads and shoulders, those inverted heads and shoulders supporting this trend line. It's very interesting to see those events reinforcing those levels. And on a 4 hours time frame chart, if you go into a lower time frame, actually, let me go into a 2 hours time frame. We have also DAX has completed also another bearish sequence. So we are trading the 113% Fibonacci from this very large swing low at 113% Fib. So if the market keeps rejecting to trade above that most recent fractal, the daily fractal now under pressure, I believe the market will trade, may trade lower. So at least the expectation for that pattern is to see the DAX trading at least a 38% Fib for this pattern. So this pattern, we can draw this or something like this, 113% Fibonacci extension, completing the sequence. So that pattern, eventually it may give sequence also to this major event. You never know what will happen from here, but we have this bearish crab pattern extended at 168 extension for the DAX. At the same point on S&P, I was calling people attention for this specific price for one specific reason. I remember on January last year, I was saying if this was a 15 minutes time frame chart, as soon as the market breaks above these highs, I will see the market trading higher, and eventually I will see the market searching for that 200% Fibonacci extension. And I remember as it was.
There you go. The market found it.
and the market actually found that level. But obviously, we never know what will happen from here. And the market is extremely heavy at this point. I'm not so sure if the market will not trade even higher from here. We keep inside this tiny and shiny ascending parallel structure. We need to see more for that to happen. So this is S&P also trading my 33.15. On the other side, we have WTI also reinforcing this is a lower time frame or a lower degree event. So reinforcing.
Yeah, I have the same trend line with you there.
Yeah, we have this ascending support there. If you go into a 2 hours time frame chart, I published these charts before this completion point being hit. So before the market breaks above.
Do you expect this rebound to be corrective?
No, eventually it can be a corrective momentum. So we have this nice impulsive swing here, Steve.
Because Gregor was here yesterday. He's expecting a corrective rebound, and I as well. I mean, I view this market more or less as he does. So I think that you know, this rebound is not going to be long lived. I think it's going to be quite short lived.
I'm not sure of how long it will be, but I'm sure about the ratios that those patterns tends to find to search for. So
38.2 confluences nicely with the previous lows there. Eh?
Previous lows there. Eventually, this is a 2 hours time frame chart. Eventually, the pressure from that 200 moving average also approaching from above. Eventually, it will make some pressure. So 38% fib, it's the minimum expectation for the pattern. This is an extended pattern at 224% fib, reinforcing this ascending structure support and reinforced already by 2 fractals, the daily fractal below and a few points above, reinforcing also the potential for a bounce from these levels. So at least a 38% fib, it's the minimum expectation for that pattern. Then on silver, I saw the market rejecting, first of all, we have a fractal there, but rejecting these previous trend line resistance or kind of, and reinforcing this trend line support, this green line that I have drawn here.
Yeah, the big question is, do you think that this is a continuation to the upside for new highs, or you would be looking to short this move?
Who knows? Let me see how the market will react as soon as the market approaches those levels, if that will happen. We never know if that will happen. 1844, this is the 168 extension. This is the previous structure highs. Eventually, the market will feel some pressure there with the golden fib, actually, also the 61.8% Fibonacci retracement, just a few points below. So we have a nice cluster there at the previous structure highs. I need to see a breakout of these previous highs at 1815 to validate or to increase the probability to form that pattern above. So that pattern is nothing more than eventual bearish shark pattern projected at 168 extension. And as you know, and as I used to share among our community, that pattern can also extend to 1874. So let's see how the market will react from those levels if the market approaches those levels. At this point, the market is feeling nice pressure at 38% fib. So as we know, a rejection of that Fibonacci retracement, it can produce some pullback at this point. So I will not ignore that possibility without feeling those criteria above. But as I used to say, I search for those events and for those trigger points. And then I react accordingly. So I don't know if the market will trade at those levels at this point. I was, and I still am positioned from below. So I found a way to enter into a long as soon as I saw the retest of this structure and the reinforcement of this structure support, the 50% Fibonacci also supporting the price there with the 200 moving average also approaching from below. So I took that opportunity. I don't know what will happen next. If the price approaches those levels, I believe that it may feel some pressure there. I have nothing specific for gold. It will follow the same thoughts as for silver. Someone on our chat has talked about the eventual edge and shoulders. Eventually, the right shoulder is starting to fade away. So eventually the market will reinforce that next zone before printing the right shoulder. And actually the price behavior is not so it's not familiar, or it's not so not synced with the default symmetry. So it's starting to fade away the eventual formation of this right shoulder. But what I see is and note that we are trading the monthly fractal resistance. So this was a fractal printed last September. So we are actually threatening the recovery of that level. So in the recovery of that monthly fractal resistance, may increase also the probability to trade lower from here. If the market trades above these 1563, that will open the door, that will open, let's say, the window to form patterns above, and very similar as on silver, the confluence between the golden extension and the golden retracement level, forging a nice box there, retesting also previous structure highs. Let's see how the market will behave from here. We have nothing specific in terms of completed patterns for the metals. The Dixie, as shared before the completion point, actually a few of them, we have a Dixie being extremely constructive, both on lower degree and higher degree time frames, or higher time frames, with a bearish outbat pattern there, a bearish cipher pattern that I shared also, retesting that 200 moving average. It has been forced to trade lower, and then most recently the bearish pattern at 88% fee. So 1 second and the third time rejecting that level, offering a nice opportunity to target the default retracement, the default 38% fee, but at 97.12 or something like that, reinforced by the new fractal, the most recent at least, 97.09. So as mentioned before, we are now threatening or approaching, let's say, this descending trendline resistance as a potential resistance. We never know what will happen there. They are there to be broken also, so we never know. If that happens, we have also another two levels that we need to pay attention for. One of them at 97.88, a false breakout above those highs at 1%, 113% Fibonacci extension. And if those patterns fails as a potential reversal, and that's what we expect for the BAT pattern or the alt BAT pattern, we want to see a deeper pullback. If that fails, we will see the market searching for higher prices for sure. So if the market fails to trade lower, it will trade higher. So, and if that happens, we will see eventually a retest of the major weekly fractal at 98.54. And if I increase my time frame a little bit, just into 4 hours time frame chart, nothing will, well, I will not be admired to see the Dixie trading even higher. So we have also the 169 extension from this very last swing low, so the projected at 98.73. So I will not ignore that possibility. And we have a nice box there between those both of those golden Fibonacci extensions there. So that's what I see for the Dixie breaking above this resistance.
So Andre, where would that target euro if this manifests?
And let me show you my euro options. Let me just change here one synced with the other one. So this is a 4 hours time frame chart for euro versus dollar. And I see some similar behavior at this point. So, and if I take in consideration this previous behavior, like this head and shoulders formation there,
Yeah.
I will not be surprised to see. Let me give a price. 200% Fibonacci, 109.70, and the 168 extension right below at 109, just a few points below the golden Fibonacci extension. So these patterns, obviously, it needs time to form. We need to see a violation of these eventual structure support. So this is the eventual heads and shoulders and the breakout of that level, very similar to the previous swing printed there. So I will not be surprised to see that happen. And on the other way, we have also pointing to the same price level, obviously, but we have these, it's a different structure at this point. We have this ascending structure support. We are now threatening this broken descending trend line resistance. So we are threatening those levels. I will not be surprised to see, it's kind of confusing, this chart. I will not be surprised to see a bounce from those levels. We have the fractal there positioned, well positioned.
Quite a mess.
Quite a mess, actually. Yeah. Let me give you a clear chart here. At the same point that Dixie was printing the bearish bat pattern, we have the bullish Gartley pattern there for euro versus dollar. So I see this as a potential right shoulder. Nothing assures me that that pattern will trigger. But that being said, trading below that daily fractal, eventually it will trigger that heads and shoulders formation. It may trigger more bearish momentum for euro versus dollar. Let's see how the market will behave from here.
Thank you.
No problem at all. We have also, let me show you the crude oil also in the crude oil I show you already, I believe.
Yeah.
Dale, show you.
Did you do S&P?
S&P already, yes, targeting our my level at 33.15. So this was my initial
so we're above
projection.
It. Okay.
We are now.
We're above everything.
26. We are above everything, exactly. I'm not sure if you were here or not, but I remember being here with you in January last year, projecting that pattern above. So at 33.15, this was my price for S&P, and there we are. And well, let's see what will happen from here.
It seemed outrageous back then. You know, and here we are.
When you take that in proportion, it's a little bit strange. The Canadian also approaching. Let me try to. Do we have an interview today, Dale? Dale? I think he's away. I'm trying to push my Canadian chart, but somehow my trading view, okay. The Canadian dollar also actually retesting the broken trend line after finding some support a few points below the bullish alt pattern completion point, the 113% fib. We are now moving sideways, but above this trend line, there's obviously two options only. One of them, a bounce and a breakout above this daily resistance, which may trigger more upside momentum, or a rejection, and we will consider this as a false or the outside return with the price recovering again the descending trend line resistance. At this point, the market's still bearish.
You have a daily on it to wrap it up for some more longer term look, because if crude is peaking, there could be something better rally maybe.
I've published for our community, actually, I believe, this chart, let me try to give you a price.
Okay.
An extension of this very last swing high projected at 168 extension. So that will be my ultimate level of pressure.
32?
The exact price at 22.29.
61.8 back is what you're talking about.
Is that a good price for you, Dale?
Oh, I would just, any price is a good price.
Any price.
Okay, so you're looking for a 61.8 back on this around 132.
Eventually, yes,
Okay.
eventually. But one step after another, if I see a pattern during that process, who knows what we need to do, no?
Okay, well, thank you, Andre, for dropping in today, buddy. It was great to see your work. Hi, Boris. I'm going to get you all set up here, buddy. Okay, you're unmuted. And Andre, if you would just stop your share so Boris can share.
Okay,
hey guys.
Share.
Hey Boris, how are you, partner?
Great.
Welcome.
Okay, so have you been in Zoom before?
Yeah, more or less. I'm going to share my desktop.
Okay. All right.
Are you guys seeing it?
Yep. See it, hear it. Welcome back. And I'm interested in what you talked about last night, your outlook for 2020. That's your theme, right?
Yeah, absolutely. We'll talk about that. I just bought gold at a bad price. Because I was late, so I bought it up a little bit. But we're basically long around 15.55 right now. Stop 15.50. Try and get it out around 15.58. I'll explain to you what I do with that on a daily basis, but I think you guys are going to find it very, very interesting. So anyways, welcome. Let me see.
Welcome back, buddy.
Good to be with you. We did a massive presentation yesterday, and if you guys, is there a way for me to share a link here, Dale, or anything, or like to the group, or should I just show it?
You should be able to post a link in the room as a presenter in the chat. You could post it in the chat.
In the chat. Let me see. There we go. Chat.
So you have a drop-down menu for chat, questions. The chat is under more. See where it says more up there?
Yeah, that's so obvious. That's just it's just beautiful, right? They could make it less convoluted. Okay, just one sec. I'm just going to pull up this link, because the reason why I wanted to give you this link is because if you guys are going to have a lot of questions, we're not going to have the full time to do the presentation. This has the PDF of the presentation, so you guys can look at it. So here you should be able to. Wait, did I see
the link?
Did everybody get that?
Yeah.
Okay, awesome. All right, so here's the link, so this way you won't have to bother me with questions on this. Okay.
Bother you?
Wait, hold on. How do I get rid of the just exit? Okay, I exit out.
All right, so we're still looking at your gold chart and your setup.
Yeah, my gold chart. Gold's been a monster. Blake's been posting about the fact that it's doing the undoable, which is, gold is rising as equities are rising, right? That's it's a very, very unusual situation. This is a very specific setup, and I'm going to go through this with you because this is like one of my favorite day trades in 2020 that I'm going to be doing this across all instruments. Whether it's going to work right now, of course, you never know. But principally, I just love this particular day trading structure. So I'll talk about it a little bit later. But let's start.
What was the time frame on that you're
this
using?
Is like it's a 5 minute. It doesn't matter. It's all a price structure. The beautiful thing is it's a 5 minute chart. The beautiful thing is this is, and I'm going to show you daily, weekly, monthly structures, and we'll just, you'll just give me instruments, and I'll show you how this works. And you might find it very, very interesting. By the way, this is what you're looking at right now is like a little proprietary trading view indicator that we have at BK. We have a whole bunch of interesting proprietary trading view indicators. This uses a particular strategy called Runner, but I'm actually using it on a pure Fibo basis. Like, I can't tell you how simple this particular idea is and how it's going to blow your mind as to how accurate it is. But before we get to all the trading strategies, let's talk a little bit about what's going on in the world, right? Best trades of 2020 market outlook. By the way, Dale, when they chat, since I'm not following chat, will you be able to just give me
Yeah.
the questions?
Sure.
Okay. So that you'll be my wingman on all of this.
Okay. Got
So,
it.
welcome everybody. Because you don't know me, I'm Boris Schlossberg, and my partner, Kathy Lean, BK Forex, which is actually going to be like kind of a misnomer because in 2020, we're doing a very, very big change. K is trading FX only, and I'm actually trading all of the indices and instruments. I don't know, if anybody in your room trades futures, Dale, but the CME, we work with CME. We're under contract as commentators for CME. But CME last year came out with something called the micros, which are the tiny, tiny, tiny little versions of the E-mini contracts for S&P.
Oh yeah. What's each handle worth? $5 or something?
No, nothing. That's the beauty. NASDAQ, each handle is worth $2.
Okay.
In the Dow, it's 50 cents. In the S&P, it's $5.
Oh,
So
that's what I thought. Okay.
it's literally amazing to be able to trade that because you have this incredible granularity. It's, I've basically completely changed my whole trading away from FX at this point. Not because I don't want to trade FX, but just because people wanted to do indices. We've never had the opportunity to do indices because they were just too large, I thought, for most people. And
Plus there's more trading opportunities with FX having record low vol, right?
Unbelievable. Yeah. There's so many more trades coming up in, there's like literally 1,000 trades in indices every day. And, there's 0 trades in FX. Be that as it may, Kathy has been doing an amazing job in this low volatility environment. But I just think this is the exciting product, and this is a global product. This is obviously very great for U.S. customers, but almost any customer across the world can open up an account with a brokerage firm and be able to trade U.S. indices 24 hours a day on a centralized book. Just to kind of give you an idea of like what that looks like. So this is gold, but this is the S&P 500, and you can make bid ask. You can do anything you want. It's exactly like the big boys, with just tiny little costs. So it's just so much better.
Volume huge.
Yeah, like it's their biggest volume, new product volume ever. I think they're up to like 300,000-400,000 on S&P. I think maybe 250,000 on NASDAQ.
Okay.
This is the S&P that's, it's 16, 18 all the time. This is all pre-market. And then, it's still pretty active. It's not, the point is if you want to do size, you obviously don't want to trade this, but the whole point is that 99% of people don't want to do size. You don't want to be in a position where if you make a mistake on NASDAQ and you lose, let's say you're 50 points out of the money. In this case, 50 points out of the money is only $100.
Right.
If you're on the big contract, 50 points out of the money is $1,000. That's the difference between staying in the game and not. So that's why I'm very excited. I think it just opens up the game to many, many more people with the exact same pricing.
Use less leverage.
Absolutely. It's 1/10 the leverage. 1/10 the size, same leverage, but 1/10 the size, which is really, really key. So, 2020, I think, is going to be a very, very interesting year. And obviously, if you're trading right now, it's just super easy, right? Literally, you can forget every complicated pattern you guys just saw. The only trade right now is just buy the dip, right? It's the easiest thing in the world. Anytime you have a dip, you just buy the dip in equities, and you're going to get rescued to the upside. But I think that's a story that ultimately is gonna end. The reason, obviously, of course, is that we have basically had globally a glut of liquidity, right? Just a tremendous amount of liquidity. Every central bank has cut rates. The U.S. central bank completely reversed course and went from saying, "Oh, everything is great, we're going to tighten rates," to cutting rates. I'm going to talk a little bit about what caused that and why that could be a much bigger problem than everybody thinks it is. But when you're kind of looking at where things are, this is exactly what Dale was talking about. This is the Dow just making record highs. It's already well out. The chart is outdated with massive volatility.
Stretch it.
And this is Euro doing nothing. I mean,
Yeah.
you could blow your brains out. I have a whole bunch of algos that trade FX, and literally, it's like the most boring thing in the world. I mean,
have you ever seen an algo commit suicide?
Yeah, I
Blow
mean,
its brains out?
exactly.
All right.
You know, they're actually some of them are making money, but like it's like I literally just, you know, I used to be like, oh, I got to check every 5 minutes. Now I'm like, I got to check every 5 days because it's so boring. And you know, that's just the story of our life these days. That's another reason why I kind of tell people that if you want to, the key thing to trading is you want to look for instruments that move, right? And that's where you want to be. So that's why what do you call it? Indices are working. Oh, look, my gold trade is working. Finally, this little biatch is moving back up. Okay, we're going to try and get out at 58. You guys, since I'm not paying any attention, we're going to try and get out at 58. If anybody sees it close to 58, let me know.
Okay.
Okay. So, anyways, macro wise, here's the thing that I think is kind of interesting, and I don't want to go through the full presentation because, as I said, I have it for you in PDF form. Macro wise, this is the heat map of PMIs, purchasing managers. This is, and what I think is fascinating about this is, so obviously red means contraction, green means super hot, ready to go, and yellow is kind of fair to midland, right?
Yeah.
And what you look at the world here, I mean, like there's just this ridiculous. We are priced in equities like this should be verdant green, right?
Yeah.
Like this should be so green it should blind your eyes. That's how high we are in terms of equity prices, and this is where we are as far as reality, right? This is like, I mean, we're barely living. This is a patient that's like not in a coma, but just stabilized. He's still in ICU. This is not a patient that is healthy and ready to run marathons, okay? You have barely. Greece is the greenest one on this chart. That's so pathetic, I can't even tell you.
Well, Steve Volge and Stelios, they've been talking about that. They've already gone through what the rest of the world may go through.
Right.
Is that what you're saying?
Maybe. No, I mean, I'm being facetious, but
okay.
But the point is that when you sort of look at a quick snapshot of how strong the global economy is, you hardly have huge amount of evidence that this is the best days ever. And equities are trading like this is the best days ever, right?
Yeah.
And I think it's because everybody understands that essentially all financial assets, but stocks especially, are really trading on one thing and one thing only: Fed liquidity, yep. Right?
Yeah.
And the thing about Fed liquidity that people can't even appreciate is they don't really like. Let me just sort of ask you. Let's see if anybody in the room will chat out the answer. In the last 3 months, in trillions of dollars, how much did the Fed add to this balance sheet?
Let's see if anyone can ask that.
In the last 3 months. 3 months.
Yeah, because of the repo. Because of the repo market.
Yeah, we're going to talk about that. But,
okay.
But I'm just saying
no one's guessed. Oh, and Chad, the link is in the chat for the PDF. Okay, go ahead, Boris. No one could guess. 1 zillion billion.
Yeah, 1 trillion billion.
Yeah.
It is
200 billion. Scott Henderson.
Half $1 trillion in 3 months.
Okay.
So that's a $2 trillion run rate. $2 trillion is what we're about to
dump tsunami
into the market. That means $2 trillion of fresh money to be used for speculative purposes. Okay? That's the pace we're on. When we were in 2008, we weren't pumping $2 trillion into this thing. I mean, it's the equivalent of just like, I don't know, every steroid in the world being used on an average, regular person's body. We're just really pumping stuff out. Now you can see, of course, this is the S&P 500 against the Fed balance sheet, right? And what you see is the Fed balance sheet. So we had expands. Then it kind of just flattens out, right? S&P goes into this parabolic run because of the tax cuts, right? So the Fed stops pumping money, the government starts pumping money. So we get the tax cuts, right? And then the government stops pumping money and the Fed stops making money, and all of a sudden the stock market just starts to have a heart attack, right?
Yeah.
So what happens now? The Fed starts, this is again, you can see the S&P 500 here is laced 2,500. Now we're at 3,200. The Fed repumps the money. Where's the S&P? Right then and there. I know people always like to say correlation is not causation, blah, blah, so on and so forth. But, you know, I think very often we overthink things. People like to create very complicated narratives for very, very simple explanations. Because if you want to understand what quantitative easing is all about, it's this. I think people don't quite understand what QE is. They keep thinking about this as something called helicopter money, where the Fed creates money of thin air, right? Well, if that was the case, if the Fed actually created money out of thin air, we would all be doing much better because we would all be much richer. If the Fed took that $2 trillion and gave you a couple of $1,000 in your bank account, if the Fed literally took that money, which exists on its balance sheet, and deposited into your bank account,
Andrew
in every
Yang.
American household, then we would have some really strong spending instead of, hang on, I'm sorry guys, just bear with me. I gotta just talk to Kathy for a second.
Sure, go ahead.
Um,
I'll talk. Go ahead.
No, go ahead. I just texted.
All right.
So the Fed didn't do that. The Fed didn't give us all. The Fed created all this money, but didn't give us all the money. What they did was they bought bonds with that money, right? Now, who owns bonds? Who owns bonds? Rich people own bonds. So if you're a rich person, you own $1 billion worth of bonds, and the Fed now buys bonds, and the bonds are now worth $1.5 billion. What happens to you? You get $500 million of profit that you didn't make, that the Fed made for you. So now you have all this extra money. So what are you going to do with all this extra money? You're going to put that into the stock market and ramp it up. And basically what is happening is that we have the Fed is taking all this money, and instead of creating spending, it has created savings. And savings is the worst possible thing. I know people always think that savings is a great thing. Savings is a great thing if you have actual real world savings that go into productive investment ideas, right? You have savings, you work hard, and then you put those into a bridge or a factory, and then the country gets richer and better. Well, that's not what's happening right now. We're basically putting it all into WeWork and all the other stupid ideas that blow up into zero because there's just not that many good ideas for way too much money. And that is how we produce very little growth in income, but massive, massive, massive stock market growth, right? All you have to do is just look at the real numbers. Again, I'm not an economist. I don't play one on TV. I'm just a simple person that looks at how things actually work in real life. So in real life, an average person making money made about $22 or $21 in 2008, and they made a little bit more than $25 in 2020. That's like 12 years worth of growth. If we had grown at our standard 3.5% growth rate, they should be making close to 30. So there's like almost a $4 or $5 difference between how much they're supposed to be making and what they're actually making, right?
Yep.
All you have to do is take a look at the decade of wage growth. The average person, how much money, let's say they just for argument's sake, they started with $10,000 salary in 2010. They now have a $13,000 salary in 2000 or $14,000 salary in 2020. Let's just be a little generous, right? So 37% growth. In the meantime, what's happened to equities? Equities have actually gone up by a factor of 10. We started at 10,000. We're now at 30,000, right? And just in proportions. So the increase in stocks, which goes to 0.1%, has been massive. The increase in actual living conditions has been putrid. And this kind of a disconnect just can't last. It just can't last. I mean, everybody's screaming they don't want Bernie Sanders and socialism, but it's coming because that's what's that's the dysfunction of the society is so bad that you get replaced with a worse dysfunction as an antidote. It's like the antidote that kills you. Ironically enough, and I'm not going to talk a political book because honestly, I have zero idea as to what's going on. We'll talk a little bit about some scenarios. But what's interesting is that Bernie is starting to beat Joe Biden, right? In the political side. Like, it just as political animals, let's understand why that's happening. Why is that? Why is my first thought, by the way, Dale, was, oh my God, Larry David is going to really, really hate this.
Oh yeah, I love that show.
Because Larry David is going to have to
work a lot.
Bernie for the rest of his life on Saturday Night Live.
Yeah.
Bernie gets like that. But just, I mean, honestly, look, let's be realistic. Well,
he's going to get the youth vote because they're going to eliminate student debt and make everything free. So it could be like
But my point is, why is Bernie resonating with everybody in America, or at least the huge amount of people? You can say
the wealth disparity.
Yes, you can say his ideas are stupid, and honestly, yes, Elizabeth Warren has a much more intelligent structure for how if you want to be serious, if you want to be a real policymaker, her policies are good or bad, but they're at least real. I mean, Bernie's policies are completely crazy. He's got no policy. He's like, I'm just going to spend money, whatever. But he is resonating because he's hitting this point. People don't care about facts. The only fact they know is that I'm making $30 more than I did in 2010, while my boss is now got 3 houses instead of 1, because that's the difference. Okay, and that just can't last. That's the bottom line. You can give me 1,000 excuses, but that's the bottom line.
It's like the best of times and the worst of times, exactly. Right?
Now, as we stand right now, as far as election goes, and that's obviously going to be a very, very big factor as we go forward, is I think everybody would have to agree that it's Trump's to lose, right? It's really Trump's to lose. You look at this field. I like Pete Buttigieg because I think he's the most talented politician of our generation. But he's young. And he's just completely not connecting with the minority groups.
Don't you think he'd be a great number 2 on the ticket if either Biden or Bernie get the nomination and they say I'm here for 1 term and I'm grooming Pete? That won't happen though. But
that's all possible. Oh wait, hold on a second. Where am I? Oh, I'm long too. You know what? I'm gonna take my gold. I'm gonna get the hell out of here.
Nice live trade, Boris.
Yeah, I'm gonna get out of my gold for
very few do that. That come in here.
Okay.
So
no, it wasn't.
Boris is real. He's a real trader.
1556.
So is Kathy.
0.8. Okay, sorry. Yeah, well, because we run a live trading room 24 hours a day. So it's not like I'm only a talking head on TV. We actually have to earn our living trading. But
same as it ever was, talking heads.
Exactly. But I guess here's my point, and this is just me talking. I don't understand why Biden continues to sort of command so much. I guess my point is, if it's Biden against Trump, it's literally going to be 2 Alzheimer's riddled old men against each other. I mean, the key thing, if you're sort of running against Trump, right, the one thing you need to show is complete and total intellectual competence. Because, love Trump or hate Trump, the one thing we'll agree is that he's a complete moron, right? And so you need somebody who's going to be a very, very intelligent, competent human being. And with, maybe I'm just completely, maybe the whole American population just wants to see morons run the country. Maybe that's why I'm completely befuddled as to why Biden looks so strong against this. But to me, it's 2 guys who should both be in a nursing home because they both have Alzheimer's. But, be that as it may, that's essentially the political story as it stands. And I don't want to handicap anything because there's nothing to handicap. Maybe by mid-June, none of these guys are even going to be candidates as we go forward. Who knows? What we do know is numbers. And we know that when we look at the election year, here's how assets perform, right? And this is what I think is super, super interesting. So there's obviously a lot of up and down, and there's what's interesting to me is kind of how different this marked contrast in euro, from last century to this century. But what's really, really most interesting to me is the marked contrast in gold from last century to this century, right? If you look at gold just on a purely correlation, serial basis, every year has been positive. And this year is no exception. No exception. Gold is at 7-year highs. That's really, really impressive. And the question is why, right? The question is why. So I'm going to give you a whole bunch of reasons. And I don't know if any of them are real, but more importantly, I'm going to give you a whole bunch of trades. And that's going to be, I think, much more interesting to you guys as to how to play this whole trend. So the reasons, political risks, right? Nobody knows what the hell is going to go on. I think the biggest reason in many ways, deficit spending, and we're running $1 trillion deficit right now. But more importantly, in order to finance $1 trillion deficit, the Fed is going to go to zero interest rates. Remember, what does gold love most? What does gold love the most? It loves no yield. You got no
competition.
Yield, no competition. It's like it's the ultimate mafia hit place. Gold is just the absolute winner when yields go to zero. And I think, all the bullshit aside, this is the reason why the chart looks like this. This is the reason why if we go to the dailies, the chart looks like this, right? And we're going to talk a little bit more about that in just a minute. So anyways, here's what I want to talk to you about. There are a whole bunch of risks that nobody in the mainstream media is talking to you about it. Partly because they're so arcane and so complex that nobody understands them. It took me all of Christmas vacation, about 25 different macro podcasts, a whole bunch of reading
to understand the Fed funds problem.
Yeah, to understand the repo problem.
Okay.
I call it the grim reaper of repo. But there's a couple of other more accessible problems that nobody's really talking about that I think everybody needs to understand. One is that job growth is not nearly as good as you guys think it is. And two, that Iran could be a much bigger threat than anybody understands at this point. So let's talk first about the more complex thing, which is repo, right? Repo is the repurchase market. It's basically the pawn shop of the financial world. Every day, $1.5 trillion of financial assets are pawned by all the big financial players in order to get money. Why do they need money? Well, because they have to have money, sort of to kind of disabuse you of your innocent notion of how finance works. You take your hard-earned cash, you drop it into the bank, and you think, oh, the bank's going to keep part of that cash on hold so that when I want to, have a demand for that cash, they'll give it back to me. Ha. The bank takes
lent out 10 times. Huh?
The bank takes all your money. If it could take twice your money, it would. And sometimes it does that in a sense. It'll take all your money and instantaneously puts it in, tries to speculate with it. Investments, loans, anything. It tries to, for the bank, a penny saved is a penny killed. They need to make all that money work, right? Now, why do they need money on the books? Because the government makes them do it. Because all across the world, the governments realize, holy shit, if the banks just take all the money and we have even the tiniest problem, the whole world is going to come crashing down. So we got to have the banks at least keep some money on reserves, called bank reserves, right? So there are rules. And every day, it's like kids who are, who go into detention, right? They're like grudgingly, God damn it, I gotta go get money. And how do they get money? They go to the repo market. They basically loan out all of their speculative investments, say, give me money so it looks like I have money on the books. And that's basically the repo market in a very, very New York street way explanation of what's going on, right? Now, why did this thing get crazy in September? The official story is complete bullshit. But the official
tax pressures.
Right. Yeah. The official story is, companies needed to pay their taxes, so they had a big draw on money. There was a lot of salary and bonus payments, and on top of everything else, the government rules got really, really strict. So people couldn't lend as much into the market because government made, the strict rules, right? So if you buy that, I have the Brooklyn Bridge. I'll be happy to sell you. But what people really think is good. First of all, one thing that's definitely going on is the following. This is something that's I think is going to blow your listeners' minds. We have a $1 trillion deficit, right? $1 trillion deficit. Anybody care to guess in the chat room how much of that $1 trillion has to be financed every 60 to 90 days? Like I bet most everybody thinks here, that, oh, we got a $1 trillion deficit. The federal government has a 10-year bond that they issue against it. So they have 10 years to pay back that money, or they have 5 years, or they maybe even have 30 years to pay back that money. How much of that money do you think the government has to roll over every 60 to 90 days? Any guesses in that chat room, Dale?
How about you, Richard? You guys, I know a lot of you guys follow this stuff. Anyone taking a guess here? 10% from Sandrine.
Higher.
Higher. You're cold. All.
Well, come
all
on.
of it.
If it was off,
90%. 90%.
90%.
35.
No, it's not 35, my friends. It is 60%. 2/3 of that $1 trillion has to be rolled every 30 to 90 days. Okay? Imagine if you were a company and you had a $1 trillion loan that you got to roll every 90 days. You got to go to the market and just say, hey, give me more money. Give me more money. Give me more money. You think it's the equivalent of driving a Porsche 250 miles an hour down the Autobahn and hoping against all hope that there isn't going to be any pebble on the road. That is literally what's going on. So where does that money get financed? It gets financed in repo. Who buys all that crappy U.S. debt? It's the primary dealers. What do you think they get the money to pay for all that stuff in the repo market? They got to get money to buy those bonds, and they borrow the money in the repo market every night. So the game basically is we got to borrow more money so we can finance the borrowing of the U.S. government, right? So that's a big thing, and that's absolutely a factor that's affecting the repo, right? But the real paranoid theory, the really, really dangerous theory that people are putting forth is that there is a rogue actor in the repo market. The repo market works like this. It's a private market between counterparties. So I'm JP Morgan Chase, and let's say I'm the Bank of Kansas, and I say I got $1 billion worth of, 5-year paper. I need you to finance it from me overnight at 2%. And JP Morgan says, oh, you're the Bank of Kansas? You know what? For you, 10%, my friend, 10%, 20%. Now, so the question is, why did in the repo market, generally the rates are the exact same as the Fed fund. So it's like about 2%, a little bit higher, maybe Fed fund is 175, repo maybe go to 2, right? So why did in September this thing blow up to go to like 10%, 11%, 15%? Because it's a credit issue. Because somebody doesn't trust the guy on the other side who they don't think they're good for the money. They don't think they're good for the collateral. That is the paranoid idea that is driving everything. So what happened as a result of this? Well, the Fed basically said, hey, my friends, don't worry. We're here, and we're going to offer everybody as much money as you want at the 2% rate. It doesn't matter if you're the Bank of Kansas, it doesn't matter if you're Joey's Pizzeria and you're laundering money. Doesn't matter what your credit is. We're going to give you all the 2% rates, all the money you want in order to do the repo, right? They've never done this before. So holy cow, like nobody like is talking about this. But when NASDAQ at 91.58, it looks like, oh, we just opened up. We finally came back down, huh? NASDAQ at 91.58 futures is the absolute reason for why it's happening. $500 billion of Fed-free money just got put into the equity market as a result of this, because the Fed basically said, hey, we're gonna just pay everybody's debts no matter how good they are, how bad they are, on a continuous basis. So you tell me how long that can go on before people kind of figure out what's happening. It's been going on for quite a long time because everybody trusts that the Fed is good for it. Everybody trusts that the U.S. is good for it. Everybody trusts that we're going to work our way out of it and that our money is good. But all of it is contingent on one thing and one thing only: faith. So,
well, they say that confidence is okay until people discovers the con.
Exactly, and that's the problem. So, what can trigger the con? What can make people say, hey, you know what? Maybe this isn't as beautiful as I think it is. Well, one thing that I think is interesting is that, as I was saying to you, macro ain't beautiful. This is jobs, right? Yeah, we're making jobs, but look at this. This is the jobs in the last year. That is hardly a torrid pace of growth, right? It's not just 1 month. It's not just 2 months. It's pretty ugly. It's not that pretty, right? Even retail sales yesterday. So the retail sales came out. They were finally halfway decent, but the month prior was revised downward. And so if the month prior is revised downward, the market just kind of said, oh, you know what? This number that we got today is probably a lie. It's probably going to be much lower than before. And we saw Target blow up. We saw Five Below blow up. We saw lots and lots of retailers completely miss their numbers. So to me, this all goes back to the idea that we have lots of jobs, lots of rich stocks, but very little income. And that is the single biggest problem. Because if you want the economy to function, you actually have to have income. And nobody is making money except the people who have assets. And those people are the people who need income the least, because they are useless to the greater society. If you already have 25 Mercedes in your garage, you're not going to buy any more. But if you have a old, beaten up, VW Bug, and the Fed drops $5,000 into your bag, you do that 5 million times over.
I'd go buy a Pinto.
Go buy a Pinto.
Yeah.
That's where economic activity happens. Now,
Okay.
the last undiscussed risk that I think is kind of really interesting is, so Iran. I mean, we all know the story of Iran, blah, blah, blah. Everybody's, the terrible thing that happened with the Ukrainian thing, the missiles, all that stuff. I mean, that's all kabuki theater, right? That's all completely kabuki theater. What is far more interesting and underneath is kind of troubling is this. So the whole Iran nuclear deal was basically based on the idea of let's make sure that Iranians do not get nukes, right? Like the only way you get nukes is if you enrich uranium. You enrich uranium, then you have the possibility to create a nuclear bomb, right? You don't have the product, you don't have the input, you don't have the product, right? So the whole Obama deal was basically, let's make sure they don't have enriched uranium, right? So what do we do? What did Trump do? He said, screw you, we're not going to do the deal. So the Iranians said, screw you, we're going to go back to, we're going to kick everybody out. Nobody's going to be able to see what we're doing. We're going to try and enrich uranium, right?
Yep.
Stuff that I'm reading right now says that they could be as close as 8 months away from having enough enriched uranium to actually create a feasible nuclear weapon, right? Now, so let me give you the ultimate existential scenario. North Korea is crazy, right? Kim Jong-un is crazy. And North Korea has proven one thing and one thing only, that you can be the most sadistic, vicious, disgusting human being in the world. And if you have a nuclear bomb in your pocket, nobody's going to touch you, right? Nobody's going to touch you. I mean, what's the single best foreign policy decision the whole world can make? A bullet to Kim Jong-un's head, right? To basically free all the North Korean people who are in a perpetual slave labor camp. Right? I don't think anybody would disagree with that.
Yeah, and if you don't believe it, the opposite was Gaddafi giving them up.
Right.
Took him out.
Right, exactly. So, but the thing is that we learned that nobody, even the United States, won't touch Kim Jong-un because he's got a nuclear bomb, right? And that is just the worst case scenario. But Kim Jong-un may be crazy, may be vicious, may be brutal, but he's not suicidal, right? In fact, he's the exact opposite of it. He wants to stay in business. He wants his children to stay in business. I mean, the whole idea of the Kim Jong, you get my idea.
Yeah.
Now, what makes Iran so interesting and so difficult?
Is because of their religious
right.
beliefs that
who here genuinely? I mean, forget. I'm not talking about religion or politics or anything else. I'm just simply asking a hardcore geopolitical question. Who here has any doubt that if there was some kind of a serious threat against Iran, or if Iran perceived as a serious threat, they would have zero hesitation at detonating a nuclear weapon anywhere and everywhere they go, right? Their suicidal impulses are far higher than any other nation in the world. And that is where you get really, truly an existential threat. So you need to watch the story of uranium enrichment. Iran gets a nuclear bomb, there literally is no solution. No solution. They will then go across the world, do as many terror as they want, and they will hold the world hostage because their response will be, you touch us, we will launch a nuclear weapon, okay? Who doubts that they will say this? Nobody, because we know it's true. So anyways, those are kind of the unforeseen risks in the market. I don't want to go through all the currencies because you guys can see that on the PDF. I will say I do want to go through pound because that's a trade for us this year. So I kind of wanted to talk to you about this. So Brexit is done. It's no longer a conversation. But I think what people completely miss, the whole idea was, we finally, let's just get Brexit done. And then once Brexit is done, we'll go back to being normal. UK will actually come back and revive itself. And it will somehow, it may be a little bit injured, but dented, but not broken, right? Well, I think for the first time, people are going to start to realize just how broken the whole story is going to be. Because if you look at the reality of Brexit, what is Brexit? In real terms, it's friction. And anytime you have friction in an economic system, you have higher costs. You got to now have a border. You got to have travel permits. You got to have market friction. All of those things are going to create more and more and more and more problems. But if you want to talk about existential risks, the true existential risk, and you already see, retail sales sucked. Even through Black Friday, they sucked. Brexit was done and they still sucked. GDP sucks. UK is going to be the first of the OECD to go into a recession this year. Mark my words. They're going to leave the world. But that's not all. The true existential threat to UK is clearing, financial clearing moves to the continent. If you think about UK economy, it's basically a one-trick pony. UK is the financial center of the world. It sits between Asia and North America. It's where everybody trades. All the FX dealers in the world are in UK. All the money flows through there. It's a very sophisticated, very, very advanced center. In fact, I don't think it's an exaggeration to say that there is no other economy in England. I mean, name me another product besides financial products when you think about England. Are you going to buy an English car? Are you going to buy an English pair of shoes? Are you going to buy, I don't know, an English computer, which doesn't even exist, right?
Who makes Bentleys?
Bentley, whatever.
Rolls.
So you're going to buy a Bentley and a Rolls, but I'm talking about real products for real people.
Okay.
There's this line of British motorcycles, but I forget what they're called. They're kind of really, really cool. I sort of really like them. I forgot what they're called. But anyways, my point being, I'm being facetious.
You're too old to be on a motorcycle, Boris. I'm not going to to allow you to do that.
I am. It's my middle.
It's a one mistake business. So
it's my middle age.
Midlife crisis.
Midlife crisis, right?
All right.
But be that as it may, here's what happens: if the Europeans and the Brits don't agree, let me put it this way. If the Brits don't agree to European way of doing business and finance, in other words, they say, here's our rule, here's the ESMA rules of how we're going to settle and clear all these financial. And the whole point of Brexit was we don't want to listen to Europe, right? Well, if they don't agree to doing business the European way, which means that they're going to be completely and totally subject to all European laws, then the Europeans are going to pull all of clearing to the continent. It's going to, and everybody's going to just simply leave for Belfast and, for Dublin and for Netherlands and for maybe even Paris and maybe even Frankfurt. I don't think it's going to come to that because the financial sector in Britain, which was incredibly anti-Brexit and totally understands that this is their lifeline, are going to do anything and everything to acquiesce to European rules. The bigger question is, will the politicians in UK go along? That's going to be the big question, because maybe they want to create autonomy, and that's going to be the absolute death knell. So to me, pound is a sell for a million fundamental reasons this whole year, and that is one of the trades.
What kind of magnitude? Parity?
Well, no. I mean, we actually, and I think now is the time, since we're kind of running out of time, now is the time to kind of talk about what are the trades of the year and where I see those trades going, right?
Yeah.
So I have a couple of ideas. They are certainly non-conventional. Oh, look at this. Finally, NASDAQ is coming in. Oh, look at that. My spreads are working. So this is my big macro trade, but this is a micro trade that we did this morning as well. What is this? This is the NASDAQ against the Dow, right?
Yeah. So a mean reversion?
Okay, I'm sorry, my friends. This just does not happen in real life, okay? This is the same companies, except this black line is the blue line with FANG, okay, with FANG attached. I mean, it's just bullshit. You right now, I guess it's a great rule of thumb that I always like to use is whenever a sector gets to be 20% of the U.S. capitalization, it's the perfect time to short the living crap out of it. So in 1999, and Dale and I are both old enough to have lived it, internet became 20% of the U.S. economy, okay? In 2007, 2008, finance became 20% of the U.S. economy, right? Guess what is, it's close enough, it's 17%.
FANG.
Guess what is almost 20% of the U.S. economy?
Apple.
FANG.
Yeah.
17% of all capitalization. Okay. So
Yeah.
my trade for the year is short the living crap out of the NASDAQ, hedge that by being long the Dow. If I am right, this is going to fall faster than the Niagara Falls. This is going to certainly fall much slower. So the differential is going to be good.
I like that.
If nothing happens, they're both going to kind of trudge along, right? The only case where I'm wrong, and I'm certainly can be wrong, is if we have just a Bitcoin parabolic move, like another 100% gain in NASDAQ against like a 20% gain in the Dow. I think at this point that is a very unlikely scenario. That's what makes.
How do you execute that trade?
There's 1,000 different ways to execute this trade.
Okay.
So the simplest, easiest way is long diamonds.
Okay.
Short QQQs on the ETF, right?
Yeah.
Another much more elegant way, which is very, very capital efficient, is using these micros. You can get, let me just sort of show you. I literally had that trade on earlier today. This is the NASDAQ. So you short the NASDAQ and you go long the diamonds. I'm sorry, long the YM, long the Dow. As a matter of fact, let me see if I can show you what we did, so you guys can actually see this thing. So I am short NASDAQ over here, when it was 91.70, and long the YM at 29,300, right? So the YM right now is basically 29,300. So I'm lost 30 points in the YM. Yeah. That is half a dollar a point. It's $15, right? So I've lost $15 on the YM. On the other hand, I was short NASDAQ at 91.70. It's now actually below 91.70. It's 91.48, but let's just call it 91.50. So I made 20 NASDAQ points. Each NASDAQ point is worth $2. So I made $40 here, lost $15 here. I am up $25 on this spread. And I'm actually going to close out the spread, guys. Close the NQ. YM spread for plus 25. Okay. Now, so that's, you know, what I'm doing right now is I'm doing this on a day-to-day basis, but I think it's actually a very, very interesting thematic trade into next year. Okay.
Okay.
And here's all the supporting evidence. You got fear, you got greed almost at 95. It's actually at 95% now. You have volatility at single digits. You know, you have all those things, right? So here are a couple of ideas. The simple one, as I said to you, short NQ, long diamonds. That's a simple trade, right? A more complicated trade that is really a lottery ticket. This is just literally a lottery ticket, but it's an interesting way of playing lottery. There's something called the SQQQ. This is the triple levered
NASDAQ on the Qs.
So what happens is if the NASDAQ drops by 1%, this thing rises by 3%, right? There
is some decay though, isn't there, Boris, on these?
Yeah. 100%. So do not trade the underlying. Do not trade the underlying. The only thing that I would say is what I think is interesting is to buy at the money calls. Every month, you just buy at the money calls on the SP. Basically, the idea is if we have a collapse in the NASDAQ, the calls are going to go 10 to 20 times their value. So you spend 0.5%, you spend 6% of your equity, 0.5% a month, and try to hit the lottery 1 out of 12 months this year. If this thing goes 20 times your money, you've more than paid for all your lottery tickets. That's a lottery ticket trade, but it's an interesting one that I think is interesting, right?
Yep.
And then if you just want to bet on volatility, which volatility at 10 is obviously very, very low, just buy. I don't know which way it's going to go, but you buy to straddle. You just buy calls, buy puts at the money on the VXX. Volatility is going to explode. Again, same kind of a thing. Just got to wait it out and let it play out. Okay. My second favorite trade, and actually this is my favorite trade of the year, is long gold. And I have a couple of really interesting ways of doing it. So, sorry, go ahead. You have a question?
Oh, I was just going to ask you on number 2, why are you more bearish than more bullish than miners than the bullion?
Oh, well, I'm getting to that. All
right, I'm jumping.
First, let's get to the simple one. So, the simple, easiest trade for somebody who doesn't want to think and just wants to see if the gold thing is real. Newmont Mining just raised their dividend, 2.6% yield. It is the only miner that is part of the S&P 500, right? So if gold takes off, here's what happens. What happens? Everybody's got to be exposed to gold, right? What's the mandated way? Everybody who owns the S&P 500 is going to need to buy Newmont Mining, right? Something like 80% of all new money now is in the index funds. So it's like it's basically guaranteed buying. It's forced. It's my favorite kind of trade where it's forced buying. You know, you're forced by regulation or convention or idiocy to do this. And you obviously want to get in front of that. If you want to get in front of forced buying, if you think gold is going to go up, Newmont Mining is the easiest thing to do. Okay?
Okay.
A more sophisticated trade is the following. So whenever gold rises, the miners rise much faster. Why? Because the way it works is the miners have a fixed cost to how much it costs them to mine gold. Just for argument's sake, let's say it costs the miners $1,000 per ounce to mine gold, right? And gold now is at $1,600, and then it goes to, let's say it goes to $1,700. So every $100 is free money to the miners. That goes straight to their bottom line. Miners trade on their price earnings ratios. So their earnings explode. When gold goes up, earnings explode because it's all marginal profit, right? So if gold goes up 50%, miners can if you go like the 1970s, you'll see how this happened. Miners ran up 300%, 500% on a stock basis, right? They go up 10 times as fast as gold because of this levered dynamic to earnings. So if you want to get kind of crazy, you can go long the gold miners index and short gold itself as a hedge, on the assumption that if gold really takes off, then the miners are going to outperform, and that's going to give you like just a vertical move on the GDX. So that's my second trade, right? The third trade is really, really, really speculative, but it's an interesting idea for those of you who are true market junkies. So first of all, let's take a look at gold. Man, look, I gave up gold too early. I totally hit my target. Okay, so let's take a look at gold on a, this is a daily basis. Yeah, this is a daily basis. Okay, this is a daily chart. Actually, maybe let me do I want to do a monthly chart. One monthly chart because I want to show you something. Sorry. This is the futures. I need to go to the underlying. Hang on. Here we go. All right, this is a monthly chart. Okay. So if you look at a monthly chart, a couple of things that pop up on gold. First of all, we ran up to 1900 and then we came back down and we held bid between 1500 and 1600 for quite a long time, right? So if you look at this right now, classic technical analysis, 1600 was support, former support becomes current resistance, right? Mm-hmm. So this trade is contingent on one variable and one variable only. Do not do this trade. Don't even think about doing this trade. Don't even conceive about doing this trade until and unless we close through the 1600 on a monthly basis. I need a monthly candle above 1600 in order to initiate this trade. Because if we get there, that means we are ready to go towards the 19. We're ready to go to 2000. That's going to be the setup. That means we're finally ready to blow to the upside. Now, once we get into that mode, right? It could take a year, it could take half months. Who the hell knows how long it's going to take? It could take, maybe a day. Who knows? The point being is we don't know how long it's going to take. But once we kind of establish ourselves up here, it's going to put ourselves into that positive mode. And when you're in an uptrend, right? What do you want to do in an uptrend? The only thing you want to, just like in stocks, the only thing you want to do in an uptrend is buy dips, right? But you don't necessarily know how and when to do it. So here's an interesting way of just kind of participating in the position without really paying too much for finding out if you're right or wrong. This is what's called it's much easier to do than it sounds. It's basically a calendar vertical spread. All we're going to do very, very simply is, remember, gold trades both the monthly expiration and weekly expiration. So we're going to trade Delta 50, which is at the money calls. We're going to buy those on a monthly basis. We're going to hold them for a whole month. And then maybe 5 points up, every 5 points up. So let's, for argument's sake, we'll buy the 1550s for Feb, 1550 Feb, right? And then we're going to sell the 1555 calls on a weekly basis. Just sell against those. If gold doesn't move, we collect the premium and it pays for the cost of the original of the monthly position. If the gold moves, we get called away. We make $5. Great. We just rinse and repeat. So this is a way to participate on a continuous basis in a long gold position without having to suffer a lot of adverse movement against you, because you pay as you go. You're using the weeklies to pay for your position, and because the weeklies are by definition will only get called away if you're going to be profitable. You're going to make money if you get called away on the weeklies. And if you don't, and if you don't get called away, you get to collect the premium on the weeklies to pay down your position on the monthlies. It's a very, very classic trade in options. Selling the weeklies against the monthlies because as usual, there's always people always pay too much for the weeklies relative to the monthlies. In terms of premium, and that's the spread.
And there's faster decay. Just
exactly.
Like dentists love decay, and so do option writers. And
exactly.
Thank you so much, Boris. We're running up on an hour here.
That's
anything
it.
you want to wrap with?
No, sorry. One last trade.
Go
So
ahead.
I promise you an FX trade. An FX trade. This is the FX trade. So
okay.
We talked about pound as my sell of the year. I love euro pound to the long side. This looks really great as a double bottom. Around my stop would be around 8,200, somewhere around there. It has a potential to go back up to 90s. That's the trade on a long-term thematic basis. Okay?
Well, thank you, Boris. You want to show your website real quick so people know how to get a hold of you?
Sure. You guys can hit us at bkforex.com. You can also, sorry, that's my membership form. You can also, let me just show you.
You have a private Twitter feed now too, don't you?
Not a private feed. I have a public feed, which I'm going to give you guys. So let me see if I can do this. I go into more. Let me just give you my Twitter feed. Where is our chat? Here we go. Chat at FX Flow. Join me, please, at FX Flow. I guarantee you'll find some interesting stuff.
Yeah.
I post all the time. A lot of, I aggregate a lot of macro data, and I think you'll find it very interesting. So follow me if you don't, and enjoy the presentation. There's a full video and a presentation that I gave you in that link, so feel free to view it. Any questions, come back to me on Twitter. I'll be happy to answer it.
The best of luck and many pips to you and Kathy, Boris. Have a great 2020.
Thank you so much, Dale. Thank you. Appreciate it very much. Take care, man. Okay.
All right, everyone. So that's a wrap for the week. Remember, don't just count your pips, count your blessings. Thanks for hanging with us, and I'll see everyone on Monday. Adios.